Hi traders, so in today's video I will talk about the strategy that I've already talked about in a previous video, but this is an advanced version of that strategy and a really well done one. It is really simple. It uses moving averages and it traces the trend or swings. So I think we should just start this video because this will be a technical one. I have a candle with me, so yeah, let's start. First of all, I think that many of you just don't know about the volume weighted moving average, but volume weighted moving averages are much better for many situations than simple moving averages, so you should check them out. And I know many of you know about the weighted moving average, but this is the advanced version of that, and it is more dependent on the volume. So if you have a strategy that is just heavily based on volume, you could switch from a simple exponential moving average to a volume weighted moving average. So what is it? Because we are traders and we want to be successful in the markets, and the markets are cruel, so you can't be lazy, and you have to have the knowledge to win, and you have to know the indicators that you use. So just look at the formulas of the indicators and I show you what is the difference between a simple moving average and a volume weighted moving average. So here is the formula of a 3-day simple moving average, and as you see, it gives the same weight to each closing price. So it is just a simple moving average, but if you look at the volume weighted moving average, you can see that actually it gives different weight to each closing price based on the volume of the certain period. So basically this is the difference between the two formulas. I think it is important to see the formulas of the indicators and understand them. So this is a simple explanation of these two indicators. Now let's go back to the charts. So I just opened a currency pair, a good one actually, with great liquidity, and it doesn't have too much really volatile periods where it go crazy. So I opened a chart with the 4-hour time frame because I prefer this time frame for this strategy. So what you should do is I will show you. Just open the simple moving average and open one volume weighted moving average. This is a built-in indicator in TradingView, and you need to this strategy is a 50 period simple moving average and a 30 period volume weighted moving average, and this will be red so we can see. Okay, so the strategy is the following. So you have these two indicators, one is a volume weighted and one is a simple, and what we will do is the following. We have three scenarios: emerging trends, trends that are already in place, and ending trends. So first we will look at the emerging trends, and with this strategy you can spot an emerging trend when the volume weighted moving average, which is the red one, crosses above the simple moving average and the price has just broken through the two moving averages in upside direction if we want to go long and it is a long trend. So here we can see that it is actually a great spot to enter a trade, because we see an emerging trend, because as you see it, the volume weighted moving average crossed above the simple one and the price just broke upwards. So here we can enter a trade. And the second thing is that I wanted to tell you is but first we should look for another opportunities, and I show you what I want to show you. So there are many opportunities that are not that good, and we should find a good one. For example, maybe this one. Yeah, so as you see here, I show you here, the volume weighted moving average, which is the red one, crossed below the simple moving average in downward direction, so it will be a short trend, and we can enter somewhere, maybe here, or because the price already here just broken below the two moving averages. So yeah, we can enter here, and now I tell you, when it is really simple. There's a simple rule for trends that are already in place, and that is basically if the volume weighted moving average is between the price, the chart, and the simple moving average. Now it is a simple strategy, and it needs your attention because of the ranging markets, but if you want to build a strategy with moving averages, this is a great start, because I have built many strategies with this start, and of course I added many filters to the strategy to eliminate those ranging markets and those many false entries, and actually just let the trades that are good reach their potential. For example, if we just enter here, it is really great because we have two exit strategies. First, I recommend a 200 pip take profit and a 50 pip stop loss. So when the price goes in totally the different direction, you can actually just cut the loss quickly, as you should, because you are a pro trader. But the following is it is really simple. One, we have a dynamic exit, and that is when we see a reversal or the end of the trend, because we don't want to lose time and we don't want to give back our pips to the market. So first of all, we have to look close to the chart when the two moving averages start to just go closer and closer to each other, and they are tighter and tighter. And when it happens, and it happens to multiple bars in a row, you have to consider to close that trade. But the actual spot where I would close this trade is somewhere here or here, but it is your taste where you want to close this trade, because it is really close to each other, the two moving averages, to multiple bars. But this this is a full cross where the volume weighted moving average crossed above the simple one. So actually that is a more safe exit if you want to to let the trade to reach its potential. But yeah, so actually when I code robots, I usually find averages between multiple dynamic exits, because in the long time it gives me a better performance based on backtest. And so yeah, now I think about it, if I had anything to add to this strategy. Yeah, so you know, I talked about sentiment in another video, actually multiple videos. So what I do when I trade any market, and for example I want to take this short trade, I look at a sentiment index and I look at it if we have some situation where I don't want to enter a trade. And yeah, so let's see. Yeah, 68% of traders are short on this market. That is pretty high, but that is just it would be just good if you know, this would happen now. So we could take this trade, because as I said, but I think you know, not everyone saw this that video. So basically what you should do is look at a sentiment index, and you should look at if this is not a really extreme number, like if it would be like 95% of traders are short on this market, I wouldn't take this trade, because that would mean that I wouldn't enter here, because that would mean that the big banks already looking at this market and they want to hunt all those traders down, and that is 100% the truth. And I can show you something, because there were a time when actually entire brokerages went broke, because here like 99% of the traders were long on this market, and the banks just broke the entire thing, and it was really sad. So this is an additional part for this strategy that is really important, actually, for every strategy. And yeah, so I hope this video was interesting for you, and you learned about the volume weighted moving average and a little bit about the client index. And you should check out my videos about the sentiment indexes, because they are the most important tools to a forex trader. Yeah, so ciao.